Welcome to the Treasury Update podcast presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in. On this episode of the podcast, host Craig Jeffery joins Managing Director Dave Robertson and Product Manager Beth Bourgoin of Deluxe Corporation to discuss the reasons and concepts around making accounts receivable undisruptible. They share valuable insights on major issues disrupting AR processes and technology-enabled solutions to position companies for success. Listen into the discussion to find out more.
I'm joined by Dave Robertson and Beth Bourgoin, both of Deluxe Corporation. Today's topic, making accounts receivable undisruptible, comes from the background of from the grounding of planes during 9/11 to hurricanes and snowstorms to COVID-19. Major issues wreak havoc on AR processes and disrupt both vital cash flows and can impact a corporation's relationship with their customers and perhaps their banks. Today I'm speaking remotely with Dave Robertson, who's the Managing Director, and Beth Bourgoin, Integrated Receivables Product Manager. They're both at Deluxe Corporation, and we're going to discuss the reasons for and concepts around making AR undisruptible. Welcome to the podcast, Beth and David.
Yes, thank you.
Thanks, Craig.
I'm looking forward to getting to some questions and hearing your responses, but disruptions are a major impact to many organizations in normal times. But at other points, when there's something significant, that can have a very disruptive activity, whether it's caused by errors, acts of men, acts of God, or from a virus. They each create problems. Let me give just some background on the issues and make sure we can leverage some recent research. So when we think about events from 9/11, that stopped planes from moving, which is what moved checks. That created a whole push towards Check 21 to stop checks as early as possible and convert them to images. We're all familiar with what hurricanes do to certain areas and how that stops the flow of more manual payments. But even today, when we're currently under the COVID-19 pandemic, creating many people to work from home, this can cause a number of people to work from home, be sent from home to become ill. And the processes around AR tend to be very manual and physical nature, and this causes a great disruption. I just want to give a couple numbers from some recent research, which the last week of the research closed on the 24th of March. And we asked some questions about liquidity and some of the concerns that people have. So the overall issue with liquidity was a top concern. The outlook was very negative. 4 times more organizations had a negative outlook than a positive outlook during the past week in the middle of the ongoing pandemic. When we drilled down and looked at some of the different elements of liquidity, from covenant requirements on debt to commercial paper, those were negative. The only positive player was central banks' liquidity after the Fed and other central banks provided a greater backstop. The most negative one by far was a deterioration in the outlook for accounts receivable. That was actually 6 times negative, which was threefold more negative than commercial paper deterioration and covenant requirements. So accounts receivable seems to be the biggest issue that people are concerned about today. Very negative view. So that background lays out some of the situation. I'd like to hear in more detail from you what you think. So feel free to expand on any of the individual items I spoke about or cover new issues about some of the areas that make AR disruptible, because that'll set us up to the talk about becoming undisruptible. And Beth, maybe you could start.
Sure. So that feedback on concerns over AR, that is really interesting. The 6 times is large, but it's also not that surprising. On a normal day, without any of the issues you just described, AR processes should be causing concern. They are unavoidable in terms of their manual processes. They're time intensive, and they're also prone to error in all pieces of the process. I think why this is interesting and so many are seeing the impact is that while the size of the effort varies, the size of the effort varies for each corporate. It may be by their industry, the size of the corporation themselves, or just the sheer payment volumes that they're dealing with. But the experience is the same at every level. And what it comes down to are numerous resources. It's resources spending hours and hours staring at screens, researching exceptions, having to research and dig into data across multiple portals. So there is nothing like an unplanned event, all those issues you just described, that none of those are better to really shine a light on these problems we already have in our normal day-to-day. So while corporates now are reviewing internally what they can be doing to keep business as usual, keep themselves afloat, they need to make sure they're running seamlessly in order to avoid negative impacts. But without accurate cash application, they're bringing a lot of risk to the table. And that risk comes in different forms. It comes in clearing out bad debt, creating unapplied cash, and even risk sending incorrect billing out to their customers. So AR is such a pain point because it really is that central piece of the order to cash cycle. And if it's prone to slowness and error, then there's also negative downstream effects on the overall process. When it comes to those pain points, it's not just that there are one or two. It's really a laundry list of manual tasks, and it comes in all forms, anything from printing bank reports, remittance emails. So those emails come in all shapes and sizes and formats and structures that have to be put together manually. They have resources manually keying thousands of invoices and physically staring at those papers for hours. Talk about being prone to error, but spending that much time just trying to match payments to remittance data. So something I find really interesting in all of this is that there's stimulating conversation everywhere and marketing on faster payments, more options to get payments completed. But what that discussion doesn't bring to the table are that it calls out and brings manual effort and more additional effort than we're seeing today to actually apply the cash. So the goal there is being achieved in the payment being sent faster. But with all of these manual AR processes, businesses might not be able to use those funds. So it really needs to be a crucial focal point for corporations today. And the last point I want to make on that is not just a lot of that's in the normal day-to-day, but if you take that normal problem, all those problems, the pain points, the risk to the business, you can multiply that exponentially when it comes to trying to work remote or even avoid close human interaction. So lots of questions coming up. Do these employees have laptops to work from home? How are they going to print out all of that paper? Can they print it out? What do they do if they can't print it out? You can't have, today when they are working with that paper, someone's going to print the paper, they're handling the exception, they're handing it over to someone else, and you can't have that physical contact today. You also can't have two people hovering over the same screen together trying to work an exception or resolve an issue. So an already disjointed process becomes even more disjointed, slow, risky, and really it's just not the time for businesses to lose that trust with their clients or lose access to their funds.
And Dave, I don't know if you had anything else on the situation or problem, if you wanted to add anything in there before I wanted to talk about how do we turn that around, how do we move from these pain points and issues to something else, but maybe Dave, you could weigh in.
Yeah, just a couple things that came to mind. I think Beth called out that you take accounts receivable, and if you think about it, it's one area of the company where you touch the customer, you touch revenue, and you also touch cash. So when you don't do it well, you have unhappy customers, you have revenue shortfalls because you're not getting paid everything you're owed, and you also have balance sheet and cash flow forecasting surprises. So it really is quite critical, but it's often taken for granted. And I think what we've seen over the last 20, 30 years, it was the last area to get funding. So all these accounts payable groups got funding and they did what they wanted to do. They created buyer portals. They created systems where, they did things the way they wanted, sending out remittance advices in the format they wanted. And that actually took a largely manual area in accounts receivable, and it put even more stress on them. So what you ended up with is a structure and an approach that was really not sustainable to begin with. And now you're adding the pandemic crisis on it and the inability to work on site, so that if a company has not really invested to pull all the data together, to put a common framework around how receivables are done so that work efforts can be dispersed and coordinated, things can be cumulatively worked on through common systems, now you're just under massive stress. And the one thing I'll say is, as a provider in the market, and as a provider that also works through banks, the amount of just desperate calls we're getting right now is unbelievable. So companies that have in-house accounts receivable operations are calling and basically saying, can you just take this? And banks are very aggressively trying to mobilize to affect strategies to help their customers, because this crisis has taken an already weak structure in some cases, and it's really brought the risk to the forefront. And so I think coming out of this, as we return to normal, if you will, there's going to be even more motivation for companies to invest in AR and make it a more sustainable, automated, and structured approach.
Certainly. Yeah, as we look at all these issues, these points of pain, is there an antidote? What are some of the key elements of the antidote or the solution for these types of pain points?
Yeah, so antidote, yes. It has even been tested and approved. I think the thing with an antidote, people get concerned over something new. But as we've been discussing thus far, this is not a new problem, so the antidote is not new either. When it comes down to what that looks like, it really is as simple as automating the process. I'm sure when I say as simple, that gets people to raise some eyebrows and really wonder why we're using the term simple. I think simple usually comes off as scary when it shouldn't. But it really is simple. It's a matter of automating the process. When it comes to automating, some corporates today are trying to automate. And I say trying because while the process of automation can be simple, it might not always be. So when corporates are finding is that when they take that on themselves, it creates a lot of challenges. So they're taking up already constrained resources, and they usually end up hitting a limit when it comes to their capabilities on what they can automate. So that's where it becomes a greater benefit to actually partner and go out and find that existing technology. And what that looks like is managing AR, managing it with artificial intelligence. When it comes to artificial intelligence, it comes in different shapes and sizes, and what benefits most and really fits into the pain points and how to create an exact solution for them, it's leveraging machine learning. That's really the major piece of the antidote. And the reason that's so important is what's being automated is that consumption of the data that's coming in all different formats, that's coming in from all these different payment sources. And what it does is brings normalization to that payment data. If that were to be handled manually, it would take hours, days, and once again bring us right back to those error-prone processes. But by normalizing the data and integrating those receivables into a single platform, you get all the perks. There's the same naming conventions among the data and the different payment sources. There are the same formats to work with. There's one report to run off of all that data and really gives businesses the tools to look further at the analytics of the data they're receiving. And that's just one level of automation. Having that data centralized and normalized for quick access. But when it comes to taking the greatest, leveraging in the biggest way machine learning, it comes into play with matching all of those remittance line items. So sometimes this remittance data we've been talking about and the emails that corporates are receiving, sometimes those are out on portals. And the AI technology, there are bots that can actually go grab that for businesses. When they're getting those remittance emails, they can be in PDFs and CSV attachments and have thousands of rows of line item data. And what it does is bring all of that together in sub-seconds. Not seconds, sub-seconds. So when it comes to the opportunity to streamline a process, really see process improvement, what's better than talking about sub-seconds versus the hours and days of the manual pieces? And it doesn't take much to see success there. I think that's the other key point when it comes to why automating is there's no need for users at the corporation to go in and rope and zone the data, template the data. Instead, there is that trusted technology. It goes in, scans that remittance data, and has the ability to align it with open receivables from an accounting system. So it's providing that matched information that can then automatically be sent back to update the accounting system, eliminating numerous manual steps and open places for error. It really is a matter of consolidating the data and then flipping the switch on for artificial intelligence to do a majority of that work in not only a faster, but more accurate manner. So we've been talking about data and all this data that is there. And I think one of the things that corporates aren't focusing on today is that they have all of this data to leverage. So leveraging the data within the corporate really gives them the opportunity to be making better business decisions, giving them quicker access to their funds. And when I think about this in terms of all the pieces and all the pain points, one way I like to reference it is actually thinking about it as the reverse process of shredding a piece of paper. So you think of that shredded piece of paper, that ugly bucket of all those pieces, and that's the data that people are manually working and piecing together today. Having seen the process go through it, I really feel like it is that painful. But all of those shredded pieces in this scenario can just as easily go through the machine and give businesses that one piece of paper back with all of the data. Now really is the opportunity for corporates to go back and fix the AR cash application issues. In today's recent disruptions, it is saving even more time and it works everywhere. So AI works remote. It eliminates that reliance on cash application centers, errors, a lack of quick access to data, and the overall disruption we've been discussing. And it doesn't have to be a long process of building history, doesn't have to require complex rules setup, but really translating those pain points and those problems that are specific to a corporate to configurations and creating a solution. So it is really exciting to know that there is supporting technology out there. It's out there already, and corporates just have to be willing to step in and take that antidote.
That's great, Beth. I like the explanation and the description of the flow. There's just a couple terms. I was wondering if you could help us through the process of understanding those and where they sit in the process of, let's say, payments coming in different forms, electronic or paper. You talked about machine learning, and it sounded like you talked about banding, and I was wondering if you were referring to things like OCR to get that, I guess, the shredded paper back into a data form that could be used by machine learning. Maybe you could talk us through the process just briefly so that we can picture it in our heads.
Absolutely. When it comes down to it and it comes down to paper, it's taking what the key is there for assisting the machine learning is having those details from an open receivables data from an accounting system. Because at the end of the day, that's where corporates are looking to go back and match their data. The goal is to update that accounting system. So if at the point of receiving the remittance data, the technology, the machine learning has access to those data points, that's what sets it up for success. So the payments come in and they have all of your basics, and it's whether it's paper, whether it's electronic, you get what corporates are used to seeing on bank reports. So you're getting your total payment amount, the date it was received, who sent it, etc. But then by incorporating the remittance data being sent over, that's where all those line item details are coming in. So it's really taking those three separate pieces. Payment data coming from the banks, the remittance data being sent by the customer, and then the receivables data from the accounting system. And that's where the machine learning goes in and replaces the manual process. So today, what I was talking about previously with the pain points, where someone manually would be scanning through all of those details and looking for how to apply information, the machine learning can go in and scan a remittance document and start testing it up against that open receivables data. So what it can do is scan the remittance and say, okay, here's a column. These all look like numbers, but I'm not sure what numbers they are. Start testing it up against that open receivables data and see, okay, this is my invoice number column. Then it just goes back to the top of the remittance data, scans everything through, and it's matched. So the exciting part there is that whole process took me longer to describe than it does for the AI to complete that task. So it's doing that in sub-seconds, whereas someone's manually piecing all of that together. So it's taking, and I think the reason it's set up for success is that it is literally translating the manual processes of taking the payment, the remittance, and the open receivables, and like you stated, banding those all together to scan the data automatically and match it up against the remittance. And I know we talked about industries a little earlier, and it really does depend on the industry. So there's flexibility in it. We may have work with an insurance company where they may want to segregate their data by home, life, and auto. We may have property managers splitting it by commercial and residential. So it's smart enough that if you tell it how your business works, it does all of that banding for you.
This is, in terms of bank services, this is probably at least 2 or 3 times more complicated than most of the other services that banks are offering. Should they really play here? And I know the answer is going to be yes, but I'd like maybe you could tell us why that's the case, given that banks are more trusted, but tech firms tend to be a lot more adaptable with some of the newer technologies. Maybe the best way to ask this is, if banks are going to play here, what should we remember about this or think about?
Yeah, and I think Deluxe is in somewhat of a unique situation because we play both sides of the fence, which sounds a little bit more complicated than it is. So we work directly with corporations that are what I would call bank agnostic. They tend to look like very large, almost counterparties to banks rather than, individual companies like a middle market company. So we work directly with them, and we kind of see how they operate. But then there is just, hundreds of thousands of middle market companies and millions of small businesses that really do prefer to go to a bank. There's a level of trust and even intimacy and rapport that the banks have. And where we're finding our bank clients succeeding is really not overcomplicating the service. And I'll share a couple things that seem to work there. But it's kind of funny, Craig, even Deluxe, when we first started offering this service, we thought, my gosh, this is really complicated. We're going to have to do all these workshops with clients and do, detailed process re-engineering and redrafting of roles and all this stuff that really looks more like the in-depth 10 to 12 week consulting project you would do for a treasury group. And when it came time to help the banks, we were really building out all these tools. And what we found was the solution that Beth's talking about, they could often sell it in 1 or 2 meetings because the benefits were compelling and the application really was not requiring them to stand on their head. But what it was really doing was pulling the data together in a logical manner and then automating things that they were doing. The real work, I think, is figuring out what to do with the additional time and creating the reporting and workflow to really get after, illegal deductions and better collection strategies. So first off, it's not as complicated as it sounds, and to do the discovery of what's required, to structure the solution, to do the business case, all of that is, I think, well within the capability of a good treasury management salesperson. The one thing we have found is that there are unique nuances by industry. So there's unique use cases, and that's just a matter of getting that expertise down and being aware of it. So what we've done there to be a little bit different, because this is a non-traditional sale, is we've created a set of data mining capabilities and sales enablement tools. So what the data mining does is we've just inventoried all the ways that a bank could create value for a customer by applying these tools. And then the data mining takes the bank's data, which is incredibly rich. You're aware of that from the work you do with bank billing and transaction data sets. Banks know pretty much all the counterparties, how they're paying, what remittance data they're getting. And from a banker's perspective, if you know the customer's industry, you know how they're using information, you know their account structure, you can kind of figure out how sophisticated they are and probably how automated their application of cash is today. So we're actually able to give banks the ability to go in and bring a business case that's pre-populated with statistical analyses to say, hey, we've got these 3 ideas for you, and here's the value it's going to create. And we think the order of magnitude of this value is X. Let us show you how it works. Here's how it would work within your environment. Here's what would change. Now let's talk about, integrating you, getting you up to speed in the right order. And we're actually finding our bank clients are closing about half these opportunities. And half of the deals they're closing are with companies under 50 million in revenue. So it's scaling down very effectively. It is a more complicated sale, but treasury management people, they're problem solvers. And if they have the right data analytics and the right sales enablement tools, pitch materials, guides to have a nice conversation around discovery, schematics to show the solution. We've even included some change management training. We're finding that the bank salespeople can sell this very effectively.
Is that, in terms of, banks making the case to take on more of these activities and do it internally, something that they haven't always done before, how you would measure this, Dave? Are they making that case because it's such a pain, it's such a issue that they have to deal with? Is that a bigger driver, or is it that the process is pretty bad and it gets improved so much that the business and the business case and the financials prove it out so quickly? What's the bigger weighting that you see?
It really varies. And sometimes you might, as a bank, go in with the analysis and say, oh my gosh, this customer, it's really all about recovering revenue on bad deductions. But, it's going to depend on what's important to that company and what gets things done at that company. So we've seen a couple drivers. So in some cases, they're just in so much pain. The people are working overtime. They're stressed. They're just, you don't need to sell them. It's like, hey, here's a life preserver. Would you like to grab it? So those are obviously, fairly simple. Typically, when we run the business case analytics, about half of the benefit is from cost savings. Now that gets a little tricky. As if you go to an area that already feels stressed and you say, hey, I've got this great solution, I'm going to cut your staff, they're going to look at you kind of suspiciously. In some cases, they know they can save the time. They may want to redeploy the people, so quantifying that is great. But sometimes it's actually showing them, hey, here's how you can improve your collections, DSO, here's how you can improve deductions management and revenue realization. And it's sometimes a revenue play. And then we had one example. We worked with this was obviously a bank agnostic company. It was a very large logistic company, over $10 billion. And their customer experience was horrible. They were sending out incorrect statements. They had unapplied cash. Customers were taking short pays just because they didn't trust the billing. And the big driver for them was partly cleaning up their balance sheet, but secondarily, it was really getting their customers to like the company more. They were at risk of losing a lot of customers just because of unhappiness with how poorly the AR operation was functioning. So again, you could do a quantitative analysis and say, this is really what should drive the decision. But as bankers or as a technology company selling direct to corporates, you've really got to figure out what is the pain point and what is the real key organizational value that's going to drive somebody to act.
So two other issues that come up sometimes in different decisions are scalability. If an organization is growing, they don't want to add a certain level of staff, a certain number of staff because they're growing too quickly. And that can factor in, that probably ties into the general financial aspect of the business case. But the disruptability issue, or the ability to be disrupted and the desire to become undisruptible, we didn't talk about that as much now. We started in the beginning talking about how that really exacerbates an already broken system. Is that factoring into people's minds, or has that been factoring into people's minds in the past? And do you think that will change with COVID-19?
Beth and I have been sort of talking about this idea of you need to future-proof your AR. It's not just COVID-19, it's preparing for real-time payments. There's a lot of factors, right? And so ideally, you make that argument, you have a visionary leader who wants to be proactive and they act on it. That's the best approach. And sometimes when we see a change in leadership, the new leader comes in and is more open-minded. Unfortunately, you often get the second point, which is, my hair is on fire and I need a bucket of water and please help me. So we're finding that we're getting a lot of frantic requests for help because companies were not undisruptible. So in fact, right now they're in stress and they're looking for help. And so it's really challenging both us as a company and our bank partners. How quickly can we get in there and get things automated and pull the data together on their behalf? So the ideal thing is you're proactive and you're looking ahead and you're really trying to anticipate risks. But I'd say when that does happen and when the crisis hits and you do need help, you still need to leave part of your brain open to not just fix this immediately, but how do I fix this in a sustainable way? And really the long-term sustainable play is having a very structured framework, an organized set of data, very clear roles, full automation, and then a framework to intelligently use data. So I would say, for any company listening or even a banker advising companies, even if your client is panicking and just wants the problem fixed, yes, you need to make their pain go away, but you can do that in a way that also sets them up so that if there's another crisis and maybe it's a financial disruption, they are now much stronger and able to withstand that because they have that level of automation, they have the data integrity, they have the structured framework where they can disperse work and be a lot more flexible in how they accommodate change and accommodate challenges.
And I think what's most interesting with that is that's all what we're seeing about ways to quickly become undisruptible once the disruption has happened. So to your point, Dave, it's how to be proactive about that. I think the other piece in what we're seeing are customers that know that the disruption is out there, and their way to become undisruptible is to avoid it altogether. So what's interesting is we've talked to some corporates who, when we ask them about their activity and their different payment types, they upfront have said, we have customers asking us to accept electronic payments and we refuse to do so because they know what's going to happen as soon as they open that door. So what's really exciting with the technology is we've had some corporates coming to us to say, we don't want to have to prevent something from happening. We want to launch our ability to offer electronic payments successfully. We want to launch them where they're already in that state where they're undisruptible. So they've actually gone out and started with leveraging the artificial intelligence and the integration and management of their receivables, and then start offering electronic payments as an offering payment source type to their clients. It is very proactive or reactive what approach our corporate's taking. But I think that's something interesting is that it really is affecting all corporates in some way, shape, or form. So they really need to understand how to become undisruptible. And it seems like whichever path they go down, whether they're avoiding it or neck deep drowning in it, it really comes to the same end point where it's looking at these automation opportunities in order to help them with their businesses.
Good point. As we approach the end of our podcast episode, I wanted to turn to any final thoughts or perspectives you might have. And Beth, I'll ask you to go first, and then Dave, maybe you could wrap it up.
Yeah, so just knowing that right now corporates are looking at their business continuity planning and really going heads down looking at their processes, now is that time to take that opportunity to look at the current process and evaluate every step today. Who's involved in which piece, which area of the company is involved where, and how they not only work together and collaborate, but how they impact each other. So taking that time to look at both the resource time as well as the cost that's associated with the way they do business today versus looking at those benefits available with automation and artificial intelligence. If they aren't already looking at it, ask themselves why. I know Dave mentioned this briefly, but is it a matter of internal change management? Is it a matter of not knowing where to start? When there is a solution out there today, it doesn't mean it has to be hard. And just because it's artificial intelligence doesn't mean it's complex. So I think the big message is to take the time to look at it and really remember this is the whole point of the solution, is to simplify and improve the process and know that there is that opportunity out there for corporates today.
You know, I was reminded of this in just contacting my clients over the past couple of weeks. You really have to start with where your customer is. And, you know, I think the benefits of getting to a target state of being fully automated, or let's say highly automated, and using data for intelligence, that's great. But one of the things we work with the banks on is really trying to figure out where the customer is in this situation. You know, are they just unstructured and everything's just all over the place? That's pretty unusual now, especially with a focus on controls. But if they don't have all the data even identified and pulled together, you know, that's kind of job one, getting them integrated. Job two is automating them. And then job three, once you automate them, the fun is beginning. It's using that data to improve all the downstream functions, automating and improving the control and accuracy of the accounting, improving the cash forecast, huge opportunity, and then just improving the deductions to revenue. So finding where they are and working them through that process is important. And then I think as well, in a time of pandemic, even just knowing psychologically where they are, you know, if you're trying to pitch a solution to a customer and they're just anxious and stressed, that's not going to work, right? You need to sort of, you know, in some cases, if you reach out to a customer and you're trying to help and they're just not ready to hear it, you sort of have to, you know, be a friend first, you know, set business aside and come back to it later when they're ready to focus. So my last takeaway would be to really use all of this, but bring it home to who your customer is, meet them where they are, and try to move them forward from where they are today.
Very good. So Beth Bourgoin and Dave Robertson, thank you so much for joining me on this episode of the Treasury Update podcast.
Yes, thank you.
Thanks, Craig.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.